Welcome to Finance with Ava. Today I'm going to give you 5 awesome quotes from Warren Buffett and apply them to financial success. Now, financial success is different for different people, but the mindset is one thing that everybody has to have to succeed with their goals for their own personal financial success. Now, with finance, there's different areas of finance. There's the educational part, there's the data part, there's the numbers part, but there is also another part that isn't taught as much in schools or anything, and that's the psychology of finance. And as part of this series right here, we're going to be breaking down what it takes mentally to get in that zone to better prepare yourself and better take action to improve your finances. And these 5 quotes are from different time periods of Warren Buffett's life, but he's reiterated them several times throughout interviews and in different books and everything like that. So you may have seen these quotes before, and how I'm going to talk about them is in a way to give examples of how you could use this and how I would personally use this and how I have used this to apply to my life with my finances to improve them and to stay on track and to just better myself financially and get in that mindset. Because once you have that mindset of financial success, it just becomes natural. You don't really think about it. You just do it because you know it's right. You know it's right to save and to invest and do this and that. But first, before we get into these quotes, let's talk about who Warren Buffett is, because there's a good chance if you're on this video, obviously right now, you're into finance even somewhat in a little bit, you probably know a little bit about Warren Buffett. To me, Warren Buffett is one of the best investors of all time. And to a lot of people, he is the same thing. He's one of the best investors of all time. To some people, I know disagree with how he invests or may not like him as a person. I don't know him personally, obviously, but as far as investing, I'm a big fan of how he invests. Now, even if you aren't a big fan of how he invests, if you just are an investor yourself, you almost pretty much have to respect his success in the investing, in the stock market and everything, because he has done an immaculate job for himself and for his company, Berkshire Hathaway, and for their investors of that company. And Warren Buffett, let's break it down a little bit here. He was born in 1930. He is the chairman and CEO of Berkshire Hathaway, and he's one of the most successful investors of all times and a generous philanthropist. He's going to give away he's been giving away a ton of his money and plans to when he passes on. And he displayed an interest in business at a young age. You should definitely read about this if you're more interested. He had different, back then I don't think they were called side hustles or everything, but he had different jobs and different things he created while he was a kid and throughout college. He actually didn't want to go to college, but ended up going anyways because of kind of his parents were wanting him to go. And actually he was rejected by Harvard but enrolled at Columbia University because Benjamin Graham taught there. And Benjamin Graham is the author of one of the best investing books of all time, The Intelligent Investor. A lot of information in that book can be applied to today. And Buffett was influenced by Graham's teachings of value investing and was mentored by him. And that was definitely played a big part in his style of investing. And in 2008, Buffett was ranked by Forbes as the richest person in the world with a net worth of $62 billion. In 2009, after donating billions to charity, he dropped to the second richest person in the world. And as of September 2022, Buffett has a net worth of $97 billion, making him the 7th richest person in the world. And he still lives in the house he purchased in 1958 for $31,500 in Omaha, Nebraska. And that's one of the things about Buffett that you definitely probably have heard if you don't know, and if you do know, the frugality of him. He is definitely, obviously, you know how rich he is, but he is not a big spender. He just recently, not that long ago, bought a private jet, and that was one of his biggest expenses. And so the frugality of how he lives is definitely different than when you see a lot of other, rich people. A lot of rich people, in general, have that kind of mindset as well, not about spending, showing off. You don't need to show you're rich. You just are. And maybe that's part of why you want to be rich. Maybe you do want to show off, but Buffett is not in that realm right there. And that's one of the things I admire about him is the frugality of his lifestyle and everything now. And also he is well known for his adherence to value investing and frugal living, as I was just speaking about. But you could definitely read more about Buffett and understand more of his mindset when it comes to investing and how he lives. He just gives a lot of good advice. There's some personal things he says, like I think he says he doesn't drink water, he just drinks Coke or something like that. I don't agree with things like that. But when it comes to investing, definitely one of my favorite people to read about and to learn from. Now let's get into these quotes. Quote 1. Do not save what is left after spending, but spend what is left after saving. This is foundational right here. You have to pretty much go into this. Now, not everybody does this that's got to the level of financial success, but most people do. Like a lot of times you might say, okay, somebody entrepreneurial, maybe they're spending more than they're saving because they're spending towards their business though. They're kind of investing in themselves. So that's kind of different. And sometimes they may be actually getting money from other people to invest in them. Now that could work, and that definitely has worked before. But if it doesn't work, then you're left with not a business at all, and you're left with a lot of debt. But just in general, for general society, for people in general, this is what I take as far as this quote with do not save what is left after spending, but spend what is left after saving. For me, how I apply this, as I want to say, is bills first, because you don't want to get behind on those and end up paying interest or late fees, because that's basically giving money away. So yeah, bills first, then save and invest, and then you can spend what is left after that. Don't even think about really spending. Like when you get paid, just go into the mindset of, okay, this is what I need to pay as far as bills, and this is how much I feel comfortable saving and investing. And if that's hard to do manually, which is understandable, make the bill paying automatic and figure out how much you're comfortable with saving and investing after paying bills, and make that automatic as well. You can set up monthly or weekly automatic transfers of money from one account that you get paid into an investing or savings account, or wherever you park your money for emergency situations. A lot of banks, and you'll see on my channel where I talk about different bank accounts, savings accounts, and checking accounts, that they have these abilities to automatically transfer funds back and forth or to this account and to that account. Set that up automatically if that's going to be better for you, easier for you. And for that savings account, or wherever you park your money for emergency situations or vacations or different things like that, definitely you want to move that over there first. However, if you already have a nice savings account built up, whether that be 3 months worth or 6 month worth of your salary, and you got that amount built up and you feel comfortable with that, then I wouldn't just keep putting money in that savings accounts. Even though savings accounts are having a nice, interest rate right now with the Fed raising their funds rates, average savings accounts around, well, not average for all of them, but for the ones that I talk about on the channel that I like to use, or around 2% right now for the interest amounts. But of course, there are still banks paying point this and point that, but check out my other videos for basically savings accounts that are paying much more than that. But if you've already have, a nice savings account built up, then I personally I transfer all of my money to an investing account, like an individual account or a Roth. That's what I suggest for that amount that you're going to save, not everything else, because you're gonna have to have some for spending, for groceries and different things like that, and gas definitely. So you transfer that money over to an account, an investing account like a Roth or an individual investing account, and having both is definitely the way to go. A Roth IRA and then having an individual investing account as well. And then after you get paid, you have to resist the comfort and ease of just leaving your money in a checking account, because that is just what a lot of people, you get paid, it's in a checking account. Okay, then you pay the bills when they're due, hopefully at least by when they're due, and you just let that money sit there. Well, of course, you're going to be spending it and just swipe because it's easy. But if you have to just mentally get in that mind frame of transferring money to where it needs to go first, to pay yourself first, and then spend what is left after saving, you can keep some money in that account and everything. So just don't get into that comfort right there is what I would not do. And when you're most likely to spend things on things you don't need, basically with money just sitting in an account. And definitely you don't want to go crazy with credit cards either, as far as like with spending. However, I like to use credit cards for the cash back and different things like that. So what I personally do is have the account, getting paid, then pay bills, had to have that set up automatically, have money transferred to a savings account, transfer it to an investing account, Roth sometimes. I don't do that every time I get paid. Try to do that throughout the year. And then as far as having money in a checking account, but using a credit card for the spending, but not going overboard, because you want to pay that off every month. You don't want the interest to pile up on that, but then you can use the money from your checking account to pay on those credit cards and everything like that. Setting that up automatically is a little bit different, because you don't know exactly how much exactly you're going to be spending on that credit card. You definitely don't want to go overboard, but you want to keep that money in that checking account to be able to pay that credit card balance off every month. If you have that mindset to pay yourself first, to save, to invest and everything like that, then you won't do a lot of frivolous spending, because you won't have a bunch of money in your account just sitting, where you just think like, oh yeah, I got however much in my checking account, I just got paid. I can buy that, I can buy that, I can buy this. And then you look back and you're like, well, my savings account hasn't grown, or my investments, they've only grown a little bit, if you have that. So you definitely want to save and invest first after paying those bills. Definitely do that first. Don't leave a balance on an account or anything like that, or pay bills late where you have those late fees and those interests and everything like that. So bills first, save and invest, then you can spend. But you don't have to spend. You can still save and invest more of that if you can, if you're going to get comfortable with that. But let's get on to the next quote. Quote number 2: price is what you pay, value is what you get. Whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. And Warren Buffett said this in a letter to shareholders in 2008. And that first part of the quote is credited to Benjamin Graham, his mentor, who he was in classes with as well, who was taught by that price is what you pay, value is what you get. Now, this quote right here, how I take this and how I like to break this down is the price of an asset like a stock or real estate, cryptocurrency, whatever. Just the price of whatever is what the price is what people are willing to pay for it and willing to sell it. So that sell price doesn't equal how much the asset is actually worth. It could be worth, more than the price. It could be worth less than it. So the value of it is what is determined, what is actually worth. Sometimes it could be close for sure. Sometimes the future assumptions could be priced in or priced out, but it's up to you to do the research and determine if something is valuable or not, or has the potential to gain in value. So once you do that, you'll understand more if the price of something is underpriced or overpriced. And with the stock market, how it's been going up and down vastly, this and that each month, each day, pretty much. Prices and value can sometimes just get wonky, get all over the place right there. But the price basically is, a lot of times price is built up in hype. You have price and overreactions. Overreactions cause prices to go different places. Hype causes prices to go different places. But the underlying foundation of the businesses that are being valued, that are pricing, that is what you need to look at. You don't need to get too wrapped up in the news headlines or, what's going on as far as like making the prices go up and down as far as like the hour. Like, yes, that's gonna affect the company's foundation and how they proceed with generating capital and cash flow and everything like that. But you have to look at the actual income statements, the balance sheets, the information, the earnings and everything to see how companies are handling, this recession or the wars and everything, inflation, different things like that, because that is what's going to determine the value of something. So you can catch a lot of things mispriced, underpriced when you actually factor in what a company is actually doing, what the value of it is, or the real estate, what the house is, what the surrounding area, the land and everything like that, what is actually the value of it, or what could be the value of it. Is the trajectory of it going up? Is it going down? You can kind of, pretty much research these things to find this out to determine if the price of what you're paying for it is underpriced or about right or anything like that. Because once you determine that, once you get that mindset of being able to actually research something, find out more about something, learn more about something, whether it be a stock, a specific stock, an ETF, real estate, land, or cryptocurrency, anything of value, anything kind of asset like that, then you could pretty much feel comfortable what you're paying for is going to pretty much appreciate in value. And then you can learn from your mistakes. If you buy something and then, at a certain price and then it keeps going down, keeps depleting and everything like that, maybe that's just a macroeconomic event, because that's what's going on right now. Macroeconomics are playing and it's pretty much causing everything to go down and everything. So, and some companies, some stocks, some cryptocurrencies, different things like that, real estate does, I don't want to say deserve to go down, but they should go down because they were overvalued. A lot of hype. Things ran up a lot in this past year or so. So some things, maybe, need to come back to Earth. They went to the moon a little bit. They went to Mars. They went to somewhere. They went out of space a little bit, but they need to come back to Earth some. And so different things like this, corrections are needed in the market to kind of get things back to a level where it could be more of a fair value. Because in general, when you zoom out of the stock market, of real estate, it's on an upward path. So you just have to pretty much get in the mindset of being able to pay for something at lower prices. And, when everything's going against the grain, lower prices or fair value, even if you buy it overpriced, then you'll know, okay, what the value of it is, what the price of it is, vice versa. And then also know whether I should hold something, where I should sell something, where I should buy more of something, and just get comfortable in that mindset to be able to know that price is what you pay, but value is what you get. And when Buffett is saying that he likes to buy quality merchandise when it's marked down, that means he likes to, you have to have, like what I like to have personally is I have a watch list of a lot of stocks. I mean, it's seriously probably like over 50 stocks, and I own several of them, but I like to pretty much have a mindset of knowing, okay, this is the price I pay for. I know the average prices. I can look that up and everything. And I say, okay, well, I would like to bring that average price cost down in quality companies, not just every company. Most of the companies I hold, I pretty much think they're quality companies and I want to hold them for a long time. So when things, microeconomic events happen, the Fed fund rate, the FOMC meetings, this and that, inflation, the CPI data, all that stuff comes out and it just, tanks the market. And then if the company that I'm holding or that I want to buy more of, or I want to start a position in, if it goes down to a certain amounts, I have it on my watch list and everything, or I have alerts and it lets me know like, hey, this happened, this price has happened, then I know, okay, I can buy this at marked down. It doesn't make me afraid to see all that red. Seeing all that red basically is like a sale to me sometimes. So when I want to look for a quality, when I have these quality companies I like to buy more of and everything, when it's marked down, when the companies are falling, tanking, maybe it's earnings, and maybe that's what something I would look more into. If earnings are on a downward trajectory, cash flows on a downward trajectory, that's something I'm going, okay, maybe this isn't quality anymore. Maybe we need to research this more. But if everything's still going well in the business, they're still growing, things are still going great, everything like that, and it's just being marked down, that's when it's a good time to buy. For me personally, what I like to do, and that's the same thing that Buffett applies to himself as well. When he's saying whether we're talking about socks or stocks, I like to buy quality merchandise when it's marked down. Just like same thing in a store. When you go into like a store, a retail store, and you see something marked down that you like, of course you're going to buy it. You don't go into the store and see a sale of something and say, no, I'm going to come back when it goes up. You got to apply that to stocks and real estate, different things like that. You go into the store, at a regular retail store, you see something marked down, it's something you like, you got to say, oh, it's buy one get one free. No, I don't want that. I'm gonna come back when it's buy one to the regular price, or something like that. I'll wait till the price goes up. You don't do that for food, you don't do that for clothes, you don't do that for electronics or anything like that. So why would you not do that for stocks and real estate assets, different things of value that can actually increase in value versus food and clothes, things like that you buy, and food of course goes away and other things go down in value, cars and things like that. But you definitely want to apply that to things that can go up in value. Just think about that. I mean, that's powerful right there. Okay, let's get to the next quote here. Quote number 3, and I didn't put these in any sort of order or anything like that as far as like most important, least important, or anything like that. They're just, this is how the order they're in. So quote number 3, be fearful when others are greedy, and be greedy only when others are fearful. Buffett stated this in a letter to shareholders in 2004, and he's also said this in a PBS interview in 2008, and I'm sure he said it many more times than that on different interviews and things like that. This is one of the quotes you probably even heard about if you know about Buffett and his famous sayings and quotes and everything like that. So with this quote, now, this can somewhat tie into the previous quote in some instances, because the combination of knowing both can lead to massive gains. When there's a crowd of fearful people, they tend to overreact and drive prices down, which can create wonderful buying opportunities for those who are willing to not let the fear distract them. Like, for example, back in the COVID crash of 2020, of course, horrible situation, pandemic, definitely not a moment to be celebrating or anything like that. But that was a time where stocks were tanking like crazy. I mean, and everybody was scared. What is going to happen? Oh, things are going to go to zero. This company's going to go out of business. And as bad as it was, you have to just pretty much ignore the fear and know what is great out there, what's going to keep succeeding, what's going to keep working. As far as like in the stock market, you got to think like, okay, is Apple going to go out of business because of this, or is Microsoft, or all these other wonderful companies that have been doing great things that have keep growing and everything like that. Just like for the financial recession, back in 2008, that crash. You got to think like, I mean, there were stocks I remember still to this day, like Starbucks was trading at single digits, and you got to think like, yeah, this is bad, like the mortgage situation, everything like that. But it's like, are people going to stop going to buying coffee? Is Starbucks going to stop growing? Like, it's things like that. You got to pretty much ignore the fear. And it's hard to do that in a mindset when it's like real life health situations or financial situations affecting people. And it's not all about money. Life's not all about money. But you can't let that stop you from your path of what you're doing in your own life personally. As far as like what's happening to society, it is definitely important to be a part of society and try to help if you can and things like that. But you also can't let it shock you into saying, okay, I need to sell off everything. I need to stop investing. And on the flip side, on the reverse of that, when there's a crowd of greedy people, they tend to overreact and drive prices up by continuing to pour money into something in hopes of making more money. And those who aren't pouring money into or holding onto the asset because they're thinking the price is going to keep going up. So you have people piling into something because they see other people piling into it. The price is going up, appreciating. You have people holding, saying like, well, I'm not going to sell. Yeah, I'm up 1,000%, 500% or whatever, but I'm going to keep holding because maybe I could be up 2,000%, 1,000%. I'm going to the moon, everything like that. And you sometimes that works. Sometimes you might be able to play that, but a lot of times you don't. It crashes and then you're down, you're under. You should have took profits. So you have to pretty much know, you can pretty much gauge this. sometimes in psychological and as far as like how finances in the stock market and different things like that work, because when you have prices that are going up so drastically, and this happened, during the COVID, actually, not after the crash, when stocks went up shortly after that, months after that, we were on this massive upward trajectory. You had people getting rich off of Dogecoin, Shiba Inu, cryptocurrencies, these meme coins, meme stocks, GameStop, things like that. So you have these assets and these things that are just jumping up in value, way surpassed by what they're actually worth if you break down the intrinsic value and everything of them, if they even have an intrinsic value. And as far as like the prices were just going outrageous, and you have to think, like, if you're in that or whatever, you have to think like, wow, this is crazy. Let me take some profits because this is not going to last. Things like that do not last right there. So that greedy mentality, it goes and it goes and goes until it gets snapped back to reality. And then sometimes it levels off and in a normal kind of playing field. Some people make money, some people lose. It just it happens. And where sometimes it goes drastically in the other situation where the fear and everything happens. Because that's kind of what's going on now. We had that drastic upward trajectory. Things are going up crazy, too fast, too furious. But also things drop too fast and too furious. So it happens on both sides. Markets and value and stocks, they drop fast. And as fast as they go up, they can drop even faster going down. So, but you have to have that mindset of not going into the crowd, not going into the herd, and being able to go against the grain. Sometimes when others are fearful, that's when it's time maybe to be a little greedy. You got the certain things at watch list, like I say. You got certain stocks you want to buy. You want to add more to your position, or that piece of land or that property. You got to have the research and everything and the knowledge. And then also when nobody's willing to buy as much or something, maybe that's a great time to buy, or maybe you need to wait a little bit while. Maybe things are going to go down. On the other side, when things are running up in price too much or everything, and maybe you're not into that stock that ran up, but it's too late to go jump in. You don't want to jump in right there after it's already ran up like in crazy amount, because that could be the top. And then you're sitting there holding the bag, or everybody else is selling. You bought the stock at $100, and now everybody sold it like 105. They're like, oh yeah, that's it, I'm out. And then it drops down to 80. You're like, no, I got it at 100. It's gonna go back up. Drops down to 70, 50, 10. And you're sitting there holding the stock you bought at $100 because you jumped in at the top, being greedy when others are greedy and everything. And if you're actually in those stocks, that run up, or you get in early or something, and it runs up, creates an opportunity where you could take profits and not be seduced by the price going up, because eventually prices can go down much quicker than they went up. And this also could be a warning to those that aren't in the asset to stay away, because at certain points, the fundamentals and the data aren't part of the price anymore, which causes assets to become overpriced. If you look at a chart of fear and sentiment compared to charts of the stock market, you'll often see a correlation of down markets being attached to fear and up markets being attached to greed and overconfidence. If you buy when the market is up and sell when it's down, you lose. However, doing the opposite can lead to massive great gains. And even if you aren't buying and selling often, these conditions can create a nice setup for long-term positions. So I definitely believe in dollar cost averaging. So when it comes to the stock market, you should be steadily investing, every week, every month, a certain amount just throughout. Because like I say, long term, you zoom out, the market is going up. The market is up. You zoom out 10 years, you're going to see some ups and downs, but overall, the market is up overall. Great companies are up overall. So you dollar cost averaging, you buy, the stock has gone from, we'll say 20 and to up to 100 right now. But in between that, it went down to 10, or it went up to 50, jumped back down to 30, went up to 80, went down to 70. You dollar cost average through that. You get an average price, but you're going to be up on that stock overall. Now, if you just buy here and there, you buy because you try to time it, you're like, oh, this is definitely the bottom, or this is the top. Yeah, you might catch it every now and then, but you're not going to have a nice average price in that stock. You may end up having too much, a higher price than the average price or anything like that, or a lower price. You may get lucky. But if you just dollar cost average throughout, just putting a certain amount throughout the ups and downs, then you'll catch a nice average price of that stock. And what I like to do that as well. But I also like to buy a little bit more for sure when that overreaction, when that fear sets in and markets are tanking, the volatility index is up and people are selling, overselling, companies are becoming undervalued. That's when I go in more into the stock market. Definitely dollar cost average throughout the volatility up and down. But when that fear really hits and the crash has really hit, that's when I like to put more into certain stocks for sure, because these can create great buying opportunities. And so definitely one thing I like to live by in investing is be fearful when others are greedy, and be greedy only when others are fearful. Next quote. Quote number 4. Your best investment is yourself. There is nothing that compares to it. Buffett stated this in the alumni magazine for Georgia Tech in 2013. And if you don't believe in yourself, you won't believe in the actions or ability to take action with your finances. Now, there's different ways to invest in yourself throughout life, and that's important to do via taking care of yourself in regards to health, family, education, career, surroundings, and etc. And much of that should be primary. For example, your health. Without life, saving money, making more money, all that, financial success is pointless. You have to have your health, so you have to take care of yourself for sure. Now, in regards to your financials, there are two main ways to invest in yourself: education and action. Now, if you're watching this video and videos like this, you're already doing step one, which is education. So good job on that. A lot of people either skip that step and make many mistakes in step number two, action, or they neither do barely of either one. You know, they do neither one, that one, or they barely do any of either, basically. So now, making mistakes happens, but those can be learning experiences. So educating yourself on finance, whether it be saving money, psychology of finance, investing, bank accounts, definitions, whatever the topic or subject is, learning more about it helps you make better decisions and more comfortable with your finances, which is important. Now, I know a lot of people say they hate money or they don't like talking about it, etc. And I'm not saying that you have to be greatly into it like me and other people in this realm are, but on a general level, it's great to be educated about money. Now, if it interests you even more, then yeah, you'll want to further educate yourself beyond the general amounts of education about money. But regardless of how your finances are, learning about your own financials and how to better save, make, and grow your finances is key to financial success. And if you're not already, make sure you're subscribed to the channel, because financial education on a basic and advanced level is one of the main things this channel is about. Now, step number two, action. No matter how much you know or don't know about finance, taking no action prohibits you from attaining financial success. Now, being educated about financials helps you make better decisions and make those decisions easier to make. And those smart actions you take with your finances are key to financial success. And when you better educate yourself in the realm of knowing how to save, grow your wealth, or different things like that, you'll have better opportunities to take action. And taking that action will become more natural because you feel that confidence. If you go into something unsure about something, either situations, you're not sure about it, you don't feel like you know enough about it, you're less likely to take that next step in that realm or whatever journey you're on. You're less likely to take a full step. You're taking half steps and sometimes, and it's not, you shouldn't definitely rush into anything. And that's definitely finances as well. But if you're confident in it, then even if you take the little steps, those are good little steps. Those are great little steps. And actually, there's another Buffett quote that plays into this, where he states that I don't look to jump over 7-foot bars. I look around for 1-foot bars that I can step over. But that's confidence right there. Yeah, you can have the confidence to try to jump over their 7-foot bars. No matter how well educated you are, or better prepared you are, your surroundings, your connections, and everything like that. Maybe those 7-foot bars are all you do. Maybe there's people that do that, and that's great. Respect. But those 1-foots right there, those 1-foot bars, you could easily step over. It doesn't take much effort. You've got the confidence. You got the education. You make enough of those steps right there. 7 easy steps is one giant 7-foot leap right there. With that education and that being that confidence, that happens with those 1-foot steps. That's those 1-foot steps right there. Those jumps, those peaks right there. You're jumping over this easiness, that ease. That's little things. That's like the automatic transfers to accounts and savings. That's investing this much a month, putting this in your Roth. Those are little steps that build up, because that is all part of compound investing, compound interest, which Albert Einstein, I believe, said this was the 8th wonder of the world. That compounding yearly, over time. And that's going to play into the next quote. Quote number 5. Someone is sitting in the shade today because someone planted a tree a long time ago. Now, Buffett stated this January 1991 in Permanent Value, the story of Warren Buffett. There's a book in 2007 right there. And there's definitely many books on Warren Buffett. He's had a couple that he published himself, but there's many more that were written about him. So you definitely check that out if you want to read more about the certain, literature of Warren Buffett and everything. But with this quote, so planning and patience are two important aspects of financial success. For this quote, the person sitting in the shade is feeling good. They're protected from the heat of the sun, but they have the ability to go in and out of the sun as they see fit. But they have that nice tree there whenever they need it. And they're sitting, so they're able to relax. So they're sitting on that tree. They're not standing on the tree. They're not trying to climb the tree. They're sitting, so they're able to relax some. And then there's a person who planted the tree a long time ago. That person wasn't in a rush to see results, because growth from planting a seed isn't instantaneous. However, they knew that it was a good idea to plant the seed because of the outcome of what the seed could be. That person likely watered the seed, which nurtured it and helped it grow into the tree that it became. Now, that person who planted the seed and is now sitting in the shade under it could be the same person. or a family member like a parent or their child or so on. So regardless, the action one took turned out to have a great result, but it took time. Financial success isn't instant. Putting $100 in a savings account and just letting it sit isn't enough. Even with a nice interest rate, it's not enough just to do that once and just go on. That's it. And yeah, compound interest is amazing. It will go towards that $100 month after month, but continuing to deposit more money into an account and letting the compound interest on a substantially more and more money, now that's exciting. You have to get started in these avenues and let time pass, but not just start and ignore, but start and continue working at it. You have to let time and money work for you together. So this quote right here: patience, patience, patience. But before patience, action. Action is what you have to take. You have to take action to even start something. So that's just planting the sitting in the shade habit because someone planted the tree a long time ago. And like I said, this could be the same person, a different person, generational wealth. This is how it goes on right here. So you have the person, you have to take the action, and then also not expect things to be instant. This isn't, something that's having financial success isn't overnight. And yeah, you read about the overnight. It sounds like success stories. Oh, this company got bought by this company, or this blew up and this is number one now. But those things weren't made overnight. The company that got bought out, and they made it or whatever, that didn't happen. That company wasn't created overnight. They worked at it for years, or maybe weeks and months. Sometimes, rarely ever, usually years of something is happening, and then that something miraculous happens that just moves it up. Or maybe it's a gradual thing. Certain things. You look at the history of great companies like right now, like Apple, for instance, they had their ups and downs. Apple almost went bankrupt at a time. Same thing with Tesla. Tesla almost went bankrupt at a time, but you had persistence, work in that company. You had reworkings, you had redesigns, you had product launches, you had different things that moved along and that made things better and better. You had one product now that made the product better now. I mean, look at the iPhone 3GS, I think the first iPhone, and they've reiterated, they keep going to what it is now, basically. So you have the action, but you also have to keep working at something, but you also have to have the patience to know that you doing both of those things, taking actions and having the patience, can definitely pay off in the long run. And it's the mindset of being able to know that you have to work on something and take the action for it, but also with your finances, you start it and you keep going at it and you see the payoff. That's one great thing about finances and numbers and things like that, is that you can look at it and see like, wow, a couple years ago I started this account and now it's at this much. Like, that wouldn't be there if you didn't start to take that action. If you didn't keep working at it, it wouldn't be there. Same thing happens on the other end, with loans and different things like that. You don't pay that loan, you don't pay that credit card, where you're going to see that interest rate pile on. It's going to pile on there. It's going to keep working against you. It's going to keep working against you. So that's a time thing too. Time works in both situations. Time can work against you, or time can work for you. With this quote, someone is sitting in the shade today because someone planted a tree a long time ago, just lets you know that there's action and there's patience and there's a payoff. Depending on what you're doing, there's going to be a reaction to it. There's going to be something that happens that's either going to be a good thing or a bad thing. And you just have to play that mentality of knowing to put all that together that you've learned, everything in this video, all these quotes and everything, and how to apply them to financial success can go together. And that is it with all the quotes in this video, but I will be continuing this series, The Psychology of Finance, with just more mental information and motivation to help people in general and succeed on the path to financial success. And this is going to be a series, like I say, Psychology of Finance. I'll make a playlist of it and everything. And that is it with the video. Hope you all enjoyed it. Take care.